You're sitting in your home office at 10:12 on a Sunday night, running a valuation model on a company you already know you're going to acquire. The numbers are done. They've been done since Thursday, but you keep the spreadsheet open, adjusting discount rates by 0.1%, stress testing assumptions you've already stress tested, logging each session as a billable advisory hour because the fund's back office system doesn't ask questions and the LP agreement gives you discretion on fee calculation. You've logged 14 hours on an analysis that took 5. The target is a mid-market logistics firm with $180 million in EBITD. The management team won't notice. They never notice. They're so eager to close that they read your fee disclosures the way people read aircraft safety cards, present for the ritual, absent for the content. A managing partner named Whitfield taught you this your second year at the fund. He took you to lunch at a club your grandfather had been a member of since 1961 and explained the economics of carry. The fund charged a 2% management fee on committed capital and 20% carry on returns above the hurdle. That math was clean and disclosed. The adjacent math, advisory fees, transaction fees, monitoring fees charged to portfolio companies, was also disclosed. Technically, in appendices that required a law degree and a tolerance for subordinate clauses to pass. Whitfield said the managers who made it understood that the fee schedule was a floor, not a ceiling. He asked if you knew the difference between a conflict of interest and a structural incentive. You said no. He smiled and said the ones who lasted understood there was no difference, only framing. You were 27. Exeter, then Princeton Economics, then Wharton MBA, a lineage so expected in your world it was almost boring. Your grandfather had built the family's original wealth in insurance. Your father had doubled it in commercial real estate. You were supposed to triple it in finance, which was less a career choice than a hereditary obligation, the way some families produce doctors or farmers. You believed in the system the way people believe in their own last name. It was just there. It was just yours. Whitfield didn't corrupt you. He introduced you to the version of yourself the industry required. You learned to structure. Everyone structured. It was architectural. A monitoring fee of $500,000 per year charged to a portfolio company that received, in exchange, quarterly calls with a junior associate and an annual visit from someone who'd actually make partner. A transaction fee on the acquisition that the company paid to the fund that had just bought it, which was technically disclosed and practically invisible given the pace of closing. Advisory fees for strategic guidance that overlapped precisely with the work you were already doing and billing through the management fee. Nobody taught you this as fraud. It was absorbed as sophistication, the difference between people who understood how value was created and people who thought value was only created in the obvious directions. By your third year, your fund had $2.1 million in AUM. By your fifth, $4.8 billion. You made managing director at 34, which was fast. The announcement came with a carry allocation that would be worth, on paper, somewhere between $8 million and $40 million, depending on outcomes, and with a handshake from the senior partner who told you the firm's next decade was being built by people like you. He meant it as a compliment. You took it as confirmation. Your base salary was $600,000. Your apartment was $18,000 a month in a building where 3 other partners lived, which was either convenient or surveillance, depending on how you thought about it. Your car was leased through a subsidiary in a way your accountant described as efficient, and your college roommate, who'd become a tax attorney, described over drinks as creative. The WolfCare staffing, $90 million in revenue, profitable but under-leveraged, owned by a founder named Chukwuemeka, who'd built it over 22 years from a single placement agency into a business that employed 340 people and held contracts with hospital systems in 4 states. He wanted a growth partner, someone to help him expand without giving up operational control. He wanted to take some money off the table. He was 58, he had reasonable retirement ambitions, and he wanted his employees to be treated as assets rather than line items. You told him in the first meeting what he wanted to hear because the first meeting is always about what the target wants to hear. You talked about his legacy. You talked about the fund's operational expertise. You talked about alignment of incentives and long-term value creation. You used the word partnership 14 times. You counted later, reviewing the transcript your assistant produced. What you didn't tell him was the model. The model said Meridian could support $55 million in additional debt if you cut overhead by 22% and renegotiated its largest hospital contracts downward to improve volume metrics at the expense of margin. The overhead reduction required eliminating 60 positions, primarily in middle management and HR, exactly the people Chukwuemeka had described as the institutional memory of his company. The contract renegotiations would compress revenue per placement, which would be fine because you were optimizing for EBITDA multiple at exit, not for the long-term health of a business you plan to hold for 4 years. You closed the deal at a $210 million valuation. Chukwuemeka took $40 million in cash and retained 15% equity, which your associates model showed was worth $30 to $50 million at exit depending on performance. It was a number designed to feel life-changing while remaining contingent enough to never require delivery. 6 months after close, you implemented the restructuring. 62 people lost their jobs in a company that had never had layoffs. Chukwuemeka called you 3 times in the first week. You took the first call. Your chief of staff handled the second. The third went to voicemail and was returned by your associate with talking points about long-term value creation and the temporary nature of transitional disruption. Chukwuemeka stopped calling. He'd learned the vocabulary of the relationship. Founder retained meant founder consulted when convenient. Growth partner meant leverage provider. Legacy preservation meant legacy as collateral. You hired a consulting firm to manage the restructuring communications. They were excellent. The severance packages were fair by industry standards. The affected employees received outplacement services through a vendor the fund had a relationship with, which also generated a small fee that was disclosed in the fund's conflict of interest policy in a paragraph on page 34 of a 67-page document. The process was clean. The process was always clean. Cleanliness was the product you were actually selling. Meridian's EBITDA improved 31% in 18 months. The fund's quarterly report cited it as a portfolio highlight. 3 LPs sent congratulatory notes. You presented the case study at an industry conference in Miami. The audience was 400 people who either had done the same thing or were planning to. An investigative piece ran in a financial trade publication. A reporter named Adeyemi had spoken to 7 former Meridian employees and to Chukwuemeka, who had apparently decided that $40 million in cash didn't fully compensate for watching 22 years of careful stewardship dismantled in 2 quarters. The piece was accurate. That was the problem with it. It described the fee structure with precision, quoted from the fund documents, traced the relationship between the consulting firm and the outplacement vendor, and included Chukwuemeka saying that he felt he'd been told a story designed to make him sign. Your communications firm drafted a response. It used phrases like rigorous value creation process and disclosed in accordance with all applicable regulations and deeply committed to our portfolio companies and their stakeholders. The phrases were accurate. They were also, in the technical sense, meaningless. The linguistic equivalent of a monitoring fee, the form of accountability without the substance. The piece generated 2 days of attention and then disappeared. The news cycle moved. The LPs held. 3 months later, you closed a new deal at a higher multiple. But something had shifted. Not your behavior, your peripheral vision. You'd read Adeyemi's piece twice. You'd read the quotes from the Meridian employees, the HR director who'd been there 14 years, the regional manager who found out via a calendar invite titled Organizational Update, the recruiter who'd turned down a competing offer 8 months before the close because she believed in the company's stability. You'd read Chukwuemeka saying he'd trusted you. You didn't change because of it. You just noticed the distance between what you said in first meetings and what you did after close with slightly more precision, which made the first meetings slightly more difficult to sit through, which made the bourbon at the end of the conference day slightly more load-bearing. 2 more years passed. Your carry position matured on 2 exits. You cleared $11 million after tax. You bought a place in Connecticut that you visit 4 weekends a year. You have a girlfriend who works in brand strategy and describes your job at dinner parties as helping companies grow, which is accurate in the way that describing weather as atmospheric conditions is accurate. A junior associate named Marchetti joined your team. He was 26, Harvard undergrad, Booth MBA, the same hunger you'd had at his age, the same fluency in the language of value creation. He asked, during a deal review, why the monitoring fee structure wasn't mentioned in the management presentation to the target's board. You told him it was addressed in the definitive agreement and the fund's disclosure documents. He nodded. He'd learned the rhythm of what got said, where, and why. You'd make sure of it. You were making another one of you. You recognized the process this time. You did it anyway. Your younger brother called on a Tuesday. He'd taken a different path, non-profit work, community development finance, a salary that would have been your monthly expense account. He asked how work was going. You said good. He said he'd read something about your fund online. You said the piece had some inaccuracies. He said he didn't think it did. There was a silence that lasted 4 seconds and contained 18 years of divergent choices. He changed the subject. You were grateful and hated yourself for the gratitude. You're 38 now, managing director, on track for senior partner in 4 years if the next fund closes at target. Your net worth is $14 million, which in your world is early stage, a number that generates mild embarrassment at certain dinners. Your grandfather's portrait hangs in your parents' house in Darien. He looks out from it with the specific confidence of a man who never questioned whether what he was building was worth building. You look like him. People have always said so. You run the model again. The acquisition makes sense at this price. It will make more sense after restructuring. The employees who lose their jobs will find others, probably, eventually, in a labor market that is fine in the aggregate, even when it is not fine for any particular person within it. The founder will receive fair value by any measurable standard, which is different from receiving what he was led to expect. But the gap between those two things is not a legal problem, and has never been a legal problem. The discount rate holds. The IRR projects at 24%. The LP returns will be strong. The carry will accumulate. The fund will grow. You close the laptop. You pour the second bourbon. You don't pour a third because you're 38 and you have a trainer at 6:30, and there are forms of discipline you still maintain. Your brother's silence sits in the room with you. You told him the piece had inaccuracies. He said he didn't think it did. He was right. You knew it when you said it. You said it anyway, because the alternative was a conversation you didn't have the architecture for yet. You look like your grandfather. People have always said so. You're still deciding if that's the point or the problem.